right now. I got to go live to the trading desk. Lots to talk about here with Victor Adair. Victor, we had the president's big speech, State of the Union, market reaction. We saw bond market reaction, currency reaction. Let me just come, though, first to those interest rates in the bond market. You may have heard Bob Hoye a little bit earlier saying, he's convinced that the bull market is over. It doesn't mean a straight line, but he's looking for higher rates down the road, that we've seen the lows.
Yeah, I really enjoyed listening to Bob. And Bobby's been a real good friend of mine for more than 30 years. I read his letter every week. And, I'm going to have to agree with him. Bobby, by the way, he's looking at a bigger sweep of time than I am most of the time. I'm a shorter-term trader. Bobby plays a longer-term game. But what we had happen this past week in the interest rate market that really captured my attention and moved the markets that I participate in was the sharp increase in the market's expectation of the Federal Reserve increasing rates at their meeting March the 15th. I mean, last week the market was thinking it was about a 40% chance. At the end of this past week here, we're up to a 95% chance. And here's where the rubber kind of meets the road on that. The yield on the 2-year U.S. Treasury note is at 1.3%, but that's a 9-year high. That's important. What's also important is that the yield spread, in other words, how much higher American rates are than other countries, is at record or near record levels against a lot of countries. So that puts extra incentive on people to be bullish the U.S. dollar or short those other currencies, whether it's Canada, yen or euro, or what have you.
And it's not a surprise. I mean, as you say, we got two banks side by side. One of them's offering a better interest rate, and really with the perception that it may be a safer bank to boot. What a surprise. We saw that Canadian dollar certainly hit that earlier this week. What was it, off about 2 cents?
Yeah, Mike, I know you said earlier maybe I could be cheerful, but it's not going to work out that way. I'll tell you, we have these measurements in the market, and on Tuesday of this week, we had a report as to who owns what in the futures markets, and we saw that the speculators had their largest bullish position in Canadian dollars in over 4 years. That's just before the bottom fell out of the Canadian dollar this week. We did drop a little better than 2 cents. We're down below 75 cents here on the close. It was down every day this week. And you kind of piece together, you wonder why. Why did that happen? I noticed, and I talked about it last week, that the Toronto stock market had a key reversal down. This talk that, Michael Levy had about the possibility, and this rumor's been floating around for a while in the market, that the government is going to whack people with an increase in the capital gain tax. Over in Alberta, we've had some major write-downs of the reserves. When the price of oil is such that maybe it's not economic to pull the oil out of the ground, then you can't call those reserves anymore. They go to a different classification. Bottom line, for the past several months, we have maintained short Canadian dollar positions. I would say this past week I became even more bearish on the Canadian dollar. I could give you a handful of reasons as to why if you're interested.
Well, I don't want to put words in your mouth, but one of the things, of course, you've been on top of with us and is about the strength of the U.S. dollar as a primary sort of longer-term trend. Well, you can see the evidence just building here, whether it's weakness in Europe, and I don't think that's even near done. The European demise isn't. I'm proud to say we've been talking about that since 2009. So money comes out of Europe, as you just alluded to. We got this interest rate differential that makes the U.S. more attractive. The list keeps going on, but I'll tell you the implications also for commodities, as an example, are there. Let me just get a quick take on crude. By the way, I'm saying that because the implications are that all the commodities are measured in U.S. dollars. So if it goes up, it kind of makes it more difficult for commodities to move with it.
Yeah, well, crude oil, I think, is the Achilles heel for Canada right here, right now. I mean, the market knows where the interest rate spreads are, and the premium of U.S. rates over Canada rates are at a level, and they were last at this level in January 16 when the Canadian dollar was at 68 cents. And I think that's going to just be a constant anchor around the neck of the Canadian dollar. But it's crude oil that has really got my attention here. Canada is hugely dependent upon crude oil exports, virtually all of which go to the United States. We've been following Joseph Schachter, paying attention to him. Basically, we've got a bearish view on crude oil. And what we do see is that in the paper oil market, that's the futures markets in the United States in particular, there are absolutely massive bets by speculators that crude oil is going to go higher. If for some reason the crude oil price does start to fall, then these guys have to become sellers and exacerbate the decline. So, and then, you have a double whammy. Crude oil prices going down, that'll put additional pressure on Canada. So to get right to the point, Mike, I am more worried about the Canadian dollar going lower, or maybe even quite a bit lower, than I've been in some time.
Yeah, and I'll tell you, one of the things that we just have to appreciate, and people have trouble with this because they have, Donald Trump elicits very strong emotional feelings, but that's not what we're talking about in the markets. That's the environment we're dealing with. The Trump administration is seen as pro-business. They're talking about lowering taxes. I think then they'll follow through on it. Less regulation. So, it's going to really make an interesting challenge for Canada, which is not perceived the same way, especially when you even have ideas like raising capital gains being floated around. These have real consequences financially, way outside of the political realm. People can have their fun debates about that this is where I say the grown-ups take over. And, there's going to be real implications. I'm also worried about the Canadian dollar in that context.
Yeah, and there's short-term things like Canada, I think in some respects is seen as a wonderful place in the world, and it truly is. You could live in some misery in a lot of other places, and Canada would look awfully good. But, the reality in the currency markets are that it's always relative to something else. The Trump administration certainly seen as pro-business. The Trudeau government, much less so. Let's say that to be kind. You get these these things that happen in sequence. The short-term things and then set off longer-term things. Longer-term things would be, from my point of view, is the amount of household and total government debt that we have in Canada. Bobby Hoy talking about people's inability to service debt, whether that's government or corporate or individual, what have you. And then, Ozzy may be going to hate me for this, but I think that Canadian households are just way over-levered to residential real estate. So if the Canadian economy which is 1/3 of our GDP is dependent on exports, crude oil, our most important export, if crude oil prices and so on, you get this ripple effect, and our inability to service some of the debt may take the leverage out of residential real estate as well. So, I don't want to be the wet blanket here, but I'm just saying I think there's some real risks to Canada, and people should, let's say, maybe hedge their exposure to a Canadian dollar being weaker.
Well, that's it for us, Mr. Cheerful. Victor, thanks for taking the time. My thanks to Victor and all of our guests. Have a great weekend.
Bye.